Welcome to Ask a Property Manager, episode number 120. Do you have a bunch of equity in your home or investment property right now due to the current real estate market? How comfortable does that make you feel? Are you in a position where you could afford a market correction? We're going to be talking about all things equity today. Stay tuned. So today we're going to be talking about equity and a very positive situation that's happening pretty much universally across the country right now with our real estate property values climbing. What does this actually mean for property owners though? We're going to be taking a look at this article from housingwire.com. Almost 45% of homeowners are now equity rich. This article was published on May 12th, 2022, so just a few days ago by Connie Kim. Let's go ahead and jump right in here. Soaring home prices continue to serve existing homeowners, with nearly 45% of all property owners now considered equity rich, a year-over-year jump that boosted 13% more homeowners into the prime position. A homeowner is considered equity rich when they have at least 50% equity in their home, a feat that's more easily accomplished with skyrocketing home price appreciation widens the gap between what someone owes on their mortgage and the value of their home. We'll be talking about that more after we're done with the article here. About 45% of mortgaged residential properties in the first quarter of 2022 had at least 50% equity in their property, according to Adam. The portion of mortgage homes that were equity rich rose from 41.9% in the fourth quarter of 21 from 31.9% in that same period in 2021. Homeowners continue to benefit from rising home prices, said Rick Sagara, Executive Vice President of Marketing Intelligence for Adam. Record levels of home equity provide financial security for millions of families and minimize the chance of another housing crash like the one we saw in 2008. But these higher home prices and rising interest rates make it extremely challenging for first-time home buyers to enter the market. In the first quarter of 2022, just 3.2% of mortgaged homes, or 1 in 31, were considered seriously underwater, meaning that the owner owed at least 25% more than the property's estimated market value. While that figure is largely unchanged from the 3.1% of seriously underwater homes in the previous quarter, it's a marked improvement from 2021's 4.7%, or 1 in 21 properties. The decade-long housing market boom, which continued from late 21 into early 22, largely has been attributed to the rise in home equity. But across the country, the median home price rose by 2% during that period to another record of $320,500. Market analysts say a glut of home buyers are chasing a historically tight supply of properties, which has also brought prices up even higher. Adam expects the home equity trend to slow in the remaining months of this year. It's likely that equity will continue to grow through the rest of 2022, although home price increases should moderate as the year goes on. Rising interest rates, the highest inflation in 40 years, and ongoing supply chain disruptions due to the war in Ukraine are likely to weaken demand and slow down home price appreciation. Nationwide, 45 states saw equity-rich levels rise from fourth quarter of 21. However, at the same time, the percentage of mortgage homes that were seriously underwater increased in 28 states. Idaho had the highest level of equity-rich properties, while Vermont, Utah, and Washington followed. Meanwhile, Mississippi ranked first for having the country's biggest portion of mortgages seriously underwater at 17%. It was trailed by Louisiana and Wyoming. So there you have it. This article kind of goes into depth and talks more about the equity position that a lot of owners are finding themselves in right now, and the inflation that's caused the inflation that's caused this appreciation, and what that actually does mean for homeowners. We're going to jump into this a little bit more in depth here. Owning a home or another asset with a substantial value is the best case scenario right now today, due to the rapid inflation that we are seeing across the country. Having equity in your home is a good thing. I don't think anyone's going to argue that fact. And the reason that equity makes so much sense right now is because of situations exactly like this, where you don't know how much longer the property values are going to continue to appreciate or hold. No one is going to argue the fact that having equity in your home is a good thing. The reason that homes make such a great asset right now is simply because of these rising market values, which is leading to more equity, just like the article says. Because of the limited supply and the large demand, right now we are continuing to see the price of these properties increase right alongside inflation, though it's not directly corollary. So it's going to help to stabilize your personal wealth situation while also buffering you against the larger financial impacts of what might be happening in the world. So essentially, when you own that asset, and the property value is going up, even if there is inflation, your asset is increasing at more or less the same rate as that inflation. Essentially, rising tides raise all ships. But everybody keeps talking about the inevitable crash. When is it going to happen? When are real estate values going to come back down? Is it ever going to happen? When is it going to happen? And here I'm going to tell you, no one has a crystal ball. No one knows what is going to happen or when it's going to happen. But really what you can do to protect yourself in the meantime is to protect your equity situation. So what happens if we see a decline in the real estate market? Well, a lot of people are going to see substantial changes in their equity. And what exactly does that mean? Well, if you bought a home for, and we're using simple round numbers here, if you bought a home for $100,000 and on the day that you closed on the property, it increased in value by 10%, you're now sitting on a property that's valued at $110,000. We're going to be looking at 3 examples here. We're going to use that same example for each one. You bought it at 100, it increased to 110,000 the same day you purchased it without you putting a penny into it or anything else. So if you bought that asset at 95% loan to value, you put $5,000 down on a conventional mortgage. For simple math's sake, you now have 15% equity in that property. 110 minus 95 equals 15. Just shy of 14% total equity in your home. You can probably afford some adjustment in the market at that rate. If the property goes from 110 down to 105, you're still okay. You have some equity position there where you can afford to absorb a little bit of an adjustment. Now, if you bought that same home on a VA loan with 0% down, now you're in a little bit different position. We're going to use that same example, bought it at 100, it's now worth 110 the day that you purchased it. You put 0% down though, which means that you're only sitting on about 9% equity, just shy of 9% equity versus the 14% equity in the previous example. So if that market adjusts back down at all, you're in a much, much, much weaker position to absorb that loss. Again, even a drop from 110 down to 105 is going to represent a bigger chunk of your equity disappearing. What about a 20% down conventional? What about the best case scenario here? So if you're sitting with a mortgage balance of $80,000 and you have a value of 110, you're sitting on just shy of 28% of the equity in your property. That's a much better position to be in if there's a market adjustment. Again, you go from 110 down to 105. In all 3 of these examples, you're still above the purchase price. So you're not underwater yet, but you can see just how much of an adjustment, just how little of an adjustment could have such a big impact. When you're sitting on a much bigger chunk of equity, obviously you have a lot more protection from market impacts, from the changing price of the market. My point here is to demonstrate the simple power of equity in a real estate deal, especially when there's uncertainty in the market about how long we're going to be able to continue to ride this gravy train of increasing property values. The golden rule of real estate is always OPM, other people's money. And that's fine right up until the point where it's no longer fine and you find yourself underwater due to a bad buy or due to a market correction or whatever the case may be. Personally, on any real estate purchase, I would say that I would want a minimum 10% down on a primary residence. I'm not looking for a 5% down conventional product right now. I would want a minimum 10% down on a primary residence. For me personally, that's my level of comfort. I would like to have some equity in there to be able to cushion the blow in the event that there is some sort of a market correction. When it comes to an investment property, again, me personally, my preference is a 20% equity window. I think that 5% down is too little on a primary residence, and I think that anything less than 20% down on an investment property is a little bit too risky. On an investment, I like things to be as bulletproof as possible. Small equity on a non-owner occupied investment is just a super risky situation to be in, especially if there's any sort of a market correction. I personally love to see 20% down on investment property, and fortunately so do most banks, especially if it's a non-owner occupied type of a situation. My recommendation here is to be very cautious about the assets that you're purchasing right now at top dollar. Top dollar right now, not to say that the market's not going to continue to increase. Top dollar today might not be top dollar tomorrow. But the flip side of that is top dollar today might be top dollar for the next decade. So that is something that you have to take into account. That is something that you have to think about when you're making real estate purchases. Because all it takes is a small dip in the market to have big consequences for homeowners and for property investors who aren't properly protected with that equity. What do you think? What's your tolerance for a risk? Let us know in the comments down below. Thanks for watching, and we'll talk to you soon.